The markets looked invincible. Stocks were setting new highs. Analysts on TV were smiling again, declaring that inflation was under control, growth was resilient, and a new wave of technology would carry us into a golden age. But beneath that optimism, a quiet signal had already turned red, and stayed red longer than at any point in modern history. It wasn't a stock chart or a headline number, it was something far more fundamental: the yield curve. The yield curve is the bond market's heartbeat, a line that shows how much it costs the government to borrow money over different periods of time. Normally, lending money for 10 years pays more interest than lending for 3 months. That's the reward for waiting longer. But sometimes the curve flips. Short-term rates rise above long-term rates, a phenomenon economists call inversion. It's like paying more rent for a short stay than a long lease. It makes no sense unless investors believe that something bad is about to happen. When that happens, the bond market isn't just making noise, it's forecasting pain. Every major U.S. recession since World War II has followed this signal. Not some of them, all of them. Yet this time, the inversion didn't just flash for a few months. It lasted for nearly 700 days, from late 2022 through the end of 2024. The longest inversion in nearly a century. That's longer than before the 2008 financial crisis, longer than before the dot-com collapse, longer than before 1929. And still, most people didn't notice. To the average investor, markets were strong, jobs were steady, and AI was rewriting the rules of productivity. Why worry about a technical line on a chart? Because that line isn't just data, it's a pulse of collective fear. The decisions of millions of investors around the world betting that safety will soon be more valuable than profit. An inverted yield curve is the market's equivalent of holding its breath. And the longer it holds, the harder it gasps when it finally exhales. We're now at the moment when that breath is ending, and history tells us what comes next. If the yield curve is the market's whisper, history is the echo. And when you listen closely, it doesn't just rhyme, it warns. The last time the curve stayed inverted for this long, the world was standing on the edge of what would become the Great Depression. In the late 1920s, the mood was euphoric. Factories were humming, unemployment was microscopic, and new technologies, radio, automobiles, electricity, were transforming life faster than anyone could imagine. Sound familiar? Investors thought they had cracked the code to endless prosperity. When the yield curve flipped in 1928, few cared. Stocks soared another 90% before reality caught up. Then, in October 1929, the music stopped. By 1932, the market had lost almost 90% of its value. Banks failed. Families lined up for bread. The same quiet warning that whispered danger in 1928 had become a global scream. Fast forward to the mid-2000s. Housing prices were exploding. Wall Street was engineering exotic new products that supposedly made risk disappear. Everyone can afford a home, they said. We've made the system smarter. In December 2005, the yield curve inverted again. But once more, the world ignored it. The market climbed for nearly 2 more years. Then came 2007. Then 2008. And by the time most people realized what that inversion had been predicting, it was too late. History has a dark sense of humor. It always tests our memory before it repeats itself. Each time the story is the same. People see the warning, but they rationalize it. This time is different. This time, technology will save us. This time, the Fed has new tools. But the bond market doesn't care about optimism or innovation. It only reflects one thing: fear of the future. And what makes the current signal so chilling is not just that it happened, but how long it lasted. The inversion that preceded 1929 lasted about 18 months. Before 2008, roughly 10. The one we just lived through, over 700 days. That's not a whisper. That's a siren that never turned off. When a warning persists that long, it's not noise, it's inevitability. History never whispers twice. It shouts the same truth again and again until someone listens. The question is, who's listening now? If history is the echo, then today's data is the thunder rolling in. The same conditions that once sparked economic collapse are quietly gathering again. Only this time, the scale is global. Let's start with consumers, the engine of the modern economy. American households are drowning in record debt. Credit card balances have smashed through the $1 trillion mark for the first time in history. Auto loans are stretching beyond 7 years, just so people can afford the monthly payments. And for millions, survival now depends on borrowing against their future. Taking cash advances to cover rent, refinancing homes to pay for groceries. That isn't prosperity, it's desperation disguised as growth. Corporate America doesn't look much better. For over a decade, companies gorged on cheap money, borrowing billions when interest rates were near zero. They told shareholders it was strategic leverage. Now, that debt is coming due, just as borrowing costs have surged to levels not seen in 20 years. Refinancing has become a nightmare. Profit margins are shrinking. Bankruptcies are quietly rising across sectors that once looked untouchable. And then there are the banks, the supposed guardians of stability. Regional lenders, the backbone of small business credit, are sitting on massive unrealized losses from long-term bonds they bought when rates were low. If those assets were valued at market prices today, many institutions would be technically insolvent, but new accounting rules let them hide the damage. It's 2008's playbook all over again, only this time the balance sheets are bigger and the safety net's thinner. Meanwhile, geopolitics adds another layer of instability. Trade wars, tariffs, and currency tensions are disrupting supply chains that were already fragile from the pandemic years. Inflation remains stubborn. Energy prices swing wildly with every new headline out of Eastern Europe or the Middle East. Central banks are caught in a cruel paradox. They must cut rates to prevent a slowdown, but doing so risks reigniting inflation. Either choice carries consequences that ripple through every market on Earth. All of these forces, debt, policy, geopolitics, psychology, are converging. Individually, they might be manageable. Together, they form a perfect storm, pressurizing the global economy like a dam about to crack. And here's the unsettling truth. The longer the pressure builds, the more catastrophic the break becomes. We've seen this movie before, but never with stakes this high. For 15 years, the global economy has been running on life support, a machine kept alive by policies that were never meant to last. After the 2008 crisis, central banks around the world did what they had to do: slash interest rates, print money, and flood the system with liquidity. It worked. For a while, markets stabilized, confidence returned, and a generation of investors grew up believing that downturns were obsolete. Every dip was met with another stimulus. Every scare was smoothed over with another rate cut. The message was clear. Risk doesn't really exist anymore, but the truth is, we didn't eliminate risk. We buried it. We pushed it into the foundations of the financial system, where it could build pressure, unseen year after year. Cheap money became a drug. Governments borrowed recklessly, assuming debt didn't matter. Corporations issued bonds to buy back their own stock, inflating prices without improving productivity. Real estate soared to levels that made ownership a fantasy for millions. Investors stopped asking if something was sustainable. They only asked how fast it could grow. When money costs nothing, bad ideas look brilliant. But when rates rise again, as they did starting in 2022, the illusion breaks. Suddenly, the system that had forgotten how to fall is forced to remember gravity. Businesses that survived only through debt begin to wobble. Consumers who built lifestyles on credit feel the strain. And policymakers who once promised soft landings realize there's no smooth way to deflate a decade-long bubble. The irony is painful. Every rescue from the past created a bigger problem for the future. Zero interest rates didn't make markets safer. They made them dependent. Quantitative easing didn't create lasting prosperity. It postponed accountability. Now, as rates normalize and liquidity drains out, we're watching the scaffolding of that artificial stability come undone. It's like a skyscraper built on rubber foundations, flexible enough to sway through minor shocks, but destined to collapse under sustained stress. The cracks are already showing. Corporate earnings are shrinking. Job openings are falling. Household savings have been nearly depleted. And yet, the optimism persists, because for 15 years, the system has been trained to believe that failure is impossible. But what happens when the system finally remembers how to fall and no one is there to catch it? When one market sneezes, the others don't just catch a cold anymore. They collapse together. That's the price of globalization. What was once a network built for efficiency has become a web of shared fragility. The next crisis won't respect borders. It won't be an American recession, a European slowdown, or an Asian currency shock. It will be all of them, simultaneously. Here's why. For decades, the world has depended on the US dollar as its reserve currency, the anchor of global trade and finance. That privilege allowed the US to borrow endlessly, exporting inflation and importing stability. But now, that foundation is cracking. Countries like China, Russia, and even some US allies are quietly reducing their dollar holdings, trading oil and commodities and alternative currencies. If confidence in the dollar erodes, the consequences will be seismic. Prices of imported goods could soar, interest rates could spike, and America's ability to finance its debt could falter, triggering a global credit shock. Meanwhile, Europe and Asia face their own ticking bombs. Europe's energy crisis exposed how dependent entire economies had become on fragile supply chains. In Asia, debt levels in both corporate and government sectors are approaching dangerous heights. China's property market, once its engine of growth, has turned into a slow-motion implosion, dragging down demand across continents. Everywhere you look, the same story plays out. Governments borrowed too much. Central banks printed too long. And the people at the bottom are paying the price. The wealth gap has become a canyon. When the next downturn arrives, it won't just erase stock portfolios, it will erode trust. Trust in currencies and banks, in the very idea that the system still works. That's what makes this era so volatile. A generation raised to believe in endless bailouts may suddenly face a world where money itself feels uncertain. And when that trust breaks, the reaction spreads faster than any contagion. A bank defaults in one country, a currency devalues in another. Investors rush to safety. Gold, farmland, hard assets. Markets tumble. Panic becomes policy. And before anyone can agree on a solution, the dominoes are already falling. Because in a hyperconnected world, collapse doesn't move in waves anymore. It happens all at once. The yield curve has already spoken. It inverted longer than at any time in modern history. And now it has returned to normal. That's the phase when the clock starts ticking. Historically, recessions don't strike while the inversion is active. They arrive after it ends, usually within 6 to 18 months. That's the lag between the warning and the impact, the calm before the storm. And we're standing right inside that window now. The data is already shifting. Consumer delinquencies are climbing, corporate earnings are thinning, layoffs are quietly spreading through industries that once bragged about labor shortages. Even government reports, which tend to trail reality, are starting to show hairline cracks in the resilient economy narrative. Still, the markets remain strangely euphoric. Investors keep telling themselves that artificial intelligence, innovation, and government intervention will bend the rules of economics once more. But history doesn't bend, it breaks. There's a saying on Wall Street, crashes don't destroy wealth. They reveal who actually had it. Or worse. That's the stage we're heading toward. Not chaos, but revelation. The illusion of permanent prosperity is about to meet the arithmetic of reality, and yet, amid all this, there's an opportunity. Not for panic, but for preparation. The people who survived past collapses weren't the ones who predicted the date. They were the ones who respected the warning, who diversified before the crash, not after, who built liquidity when everyone else was chasing momentum, who treated fear not as weakness, but as awareness. No one can stop what's coming. Markets have always cycled through excess and reckoning. But individuals can choose how deeply they're buried when the tide goes out. Because when history turns its page again, the story will repeat. The experts will say, no one could have seen it coming. The media will call it a black swan. And yet, the truth will be simple. The warning was there all along. It was written in the bond market, echoed in the data, and whispered through every lesson of the past century. The whisper became a warning. The warning became a reckoning. And now, the reckoning is becoming reality. The question isn't if it's coming, it's whether you'll be ready when it does.